And now we think it's going to broaden out into a healthy bull market, as it did from 32 to 36, 39, into the 40s, the late 60s. The exceptions were 73 and 2000. They ended up in a bear market. But even 09, which I remember very well, it broadened out into at the market recovered, and the recovery was very broad.
Hey guys, welcome to Everyday Finance. Cathie Wood, the founder of Ark Invest, has recognized a convergence of macroeconomic signals and emerging market trends. One of the elements influencing the development of technology and cryptocurrency assets is this convergence. On the weekly chart, Bitcoin has been displaying a historically bullish technical signal, which is a MACD crossover. Since the significant rally that took place in October 2024, this has not been observed. Among the most important things that have happened this week is this. Although Bitcoin recently tested highs around $16,000, it missed a technical breakout level at $14,500 by a narrow margin. In spite of this, momentum remains robust, bolstered by volatile price wicks and market reactions that are accelerating in response to outside events like US-China trade talks. Because of the Federal Reserve's decision to keep interest rates at their current level, there is now additional complexity. The technical resilience of risk assets and macroeconomic uncertainty are in a push-pull relationship as a result of this choice. This week saw a decline in key inflation indicators like the Producer Price Index, PPI, and the Consumer Price Index, CPI, which paved the way for higher volatility. Less than 2% of the entire supply of Bitcoin is in a loss position, according to data displayed on the blockchain, highlighting its resilience. This is a very uncommon sign of long-term confidence and holder strength.
What we believe is the convergence among all of the technologies that are evolving today and have entered prime time. You can see how many of these technologies are evolving, how interrelated they are, how central AI is. And you can also see something interesting here. Trueflation CPI versus the US CPI. Now, trueflation CPI tends to pick up on inflation before the US CPI, 3 to 6 months before. And you can see here, even with all the tariff turmoil, inflation indicators, this one at least, are pointing down. The last reading, I think, was 1.37%. Versus the CPI, which is a little over, I think it's at 2.5%, a little over 2.5% right now. That's the green line. Trueflation is the purple line. It's pointing down. And as we've been saying for some time, burden of proof has been on us because we did have this flattening out for a while in the 2 to 3% range. But we thought it was going to resolve to the downside. And here it does seem to be doing that. And we wouldn't be surprised to see negative inflation, just like we saw right after COVID and in late 2015, or no, that would have been early 2015 when there were some real scares about China, China exporting deflation. We think some of that is going to happen. China exporting deflation as its economy is being hurt here, I would say, rather badly by the tariffs and the technologies all coming together and creating a productivity boom, which we think is going to lead us out of the recession and create a really virtuous cycle. Productivity boom, unit growth going up dramatically, and inflation coming down, maybe into deflation. So we also explain in the letter that our kind of strategy, any innovation-based strategy not wedded to the broad-based benchmarks, has had a very difficult time facing three major headwinds during the last 4 years. One was interest rates. We think they're coming down. The second was the concentration in the market towards, a very few names. And those tended to be very cash rich, larger cap names. We think we're at the end of that headwind as well. And we'll see as this correction in the market turns into a recovery. We'll see if this is what continues to happen. It started to after the election. The tariff turmoil caused a bit of an upset. But I think coming out of this, especially if we're right that inflation's coming down, the economy is going to recover nicely, productivity leading the charge, thanks to these technologies, we think this headwind will dissipate as well, and that the bull market will broaden out. I would describe the bull market through 23, 24 as I know anyone wedded to the benchmarks won't agree with this, but as an unhealthy bull market. It was not broad. In fact, it has never been less broad. It was worse than the Depression level concentration as measured by this Goldman Sachs study. And now we think it's going to broaden out into a healthy bull market, as it did from 32 to 36, 39, into the 40s, the late 60s. The exceptions were 73 and 2000. They ended up in a bear market. But even 09, which I remember very well, it broadened out into at the market recovered, and the recovery was very broad.
One of the most interesting things about the current Bitcoin rally is how little attention it is getting from regular investors. Google searches for Bitcoin have dropped to their lowest level in 5 years, showing that small investors are still not very interested. Even though prices have gone above $15,700 for the first time in months and have never happened before, this is still the case. There isn't much hype, which is interesting because in the past, explosive cryptocurrency rallies have often happened at the same time as a lot of public interest. The way things are going now might mean that Bitcoin's growth has more room to go before it reaches the kind of euphoria that's common near market peaks. It looks like the real force behind this is how institutions act, with a number of macro and technical factors supporting the positive mood and steady accumulation. This rally isn't really being driven by small-scale speculation. It's deeper capital flows and long-term positioning, which is a good sign for the market's long-term potential to go up.
So, and then the last chart in the letter, we have more charts here and we'll go quickly through them. But the last chart in the letter talks about the third headwind. So the first was interest rates, that's gone. The second was concentration in the market, fear causing a shift towards very few stocks, cash rich, large cap. And we think that's dissipating. And then the third is certainly the valuation headwind. And you can see innovation-based strategies are at near record low valuations. When I say record low, this is the history. This is the history of Ark's life, but innovation-based strategies broadly are selling at a very low premium to the S&P 500 as measured by enterprise value to adjusted EBITDA. We worked with S&P 500 to adjust for stock-based compensation and R&D. Both the S&P and the various innovation strategies. And you can see very, very modest valuation premium. The average over the life, or at least ARK's life, on this metric is roughly 90%, I think. Taking out COVID, the COVID distortion, it's 75%. So innovation, we would say, is on sale. So let's finish up these charts quickly here. This is from Big Ideas 2025, and here are our expectations of what the broadening out of the market will mean. You can see that the Mag 6 from 2019 to 2024 tripled in market cap, whereas the rest of innovation, and we would say truly disruptive innovation, lagged badly. It was only up 30%, not even a double. You can see that we expect the Mag 6, not all of them. We worry about Apple, as we've told you many times, somewhat Alphabet as well, but all of them will be touched in some way by disruption to the traditional world order. Nonetheless, we think they will deliver good returns over time. But we do think it's now time for truly disruptive innovation, this broadening out of the market to reward the true disruptors. And so we expect more than a tenfold increase during the next 5 years in the market cap of those. And you can also see the rest of the market, we think, which really represents the traditional world order, will not see much appreciation, if any, on balance. In terms of the bond market, here's the very long term. We were in a bull market for 40 years, and we've come out of that bull market. And the question is, where now? And I want to show you a few charts. We think that maybe we're in a new normal that will be in the 2.5 to 5% range as we go into a world of perhaps stronger than expected unit growth, but lower than expected inflation. And if you look back at the last time we were in such a period, massive innovation, the 50 years that ended in the roaring 20s, what we saw was an inverted yield curve. Most of the time averaging 100 basis points, but short rates mirroring nominal GDP. So if nominal GDP is in the 4 to 5% range, maybe that's short rates. Inverted yield curve would be 3% to 4% long rates. And so forth. Just an idea.
Tariffs on both sides were lowered as a result of the historic trade agreement that the United States and China reached in Geneva. China lowered its tariffs on American imports from 125% to 10%, while the US lowered its tariffs on Chinese goods from 145% to 30%. Bitcoin saw another spike this week as a result of this action. As a result of this détente, there is a renewed sense of optimism in global markets, especially in riskier assets like Bitcoin. A classic bull flag pattern, a reliable technical indicator that suggests strong upward continuation, has been broken out by Bitcoin. Bitcoin has broken out of the pattern as a direct result of this upbeat sentiment being reflected in price action. Analysts are now concentrating on the $150,000 mark as the next big milestone, since technical indicators like the Relative Strength Index RS show ongoing strength without overbought conditions. But caution is still necessary because Bitwise sentiment data indicates that euphoria is returning to the market and is starting to resemble earlier local peaks. It's possible that there could be short-term corrections down to $100,000, especially given that daily indicators are showing a brief overheating. Despite this, the overall outlook remains bullish as the potential for a big breakout is being fueled by a combination of growing institutional accumulation, expanding geopolitical clarity, and increasing liquidity.